Let me paint you a picture. You're doing okay. Not rich, not struggling, just okay. You pay your bills on time, you have a little savings, maybe a small investment account you started a couple of years ago. You're not the person who worries about their card being declined at the grocery store. Life is relatively stable. And then, out of nowhere, you get a letter in the mail, or an email, or a notification in your banking app. It's a credit card offer. Not some basic no-frills card. We're talking premium. Rewards, travel miles, concierge service, a metal card. The kind of card that makes a sound when you set it on a table. And the first thought that crosses your mind is, why are they offering this to me? You didn't ask for it, you weren't looking for new credit. And here's the strange part, you don't really need it. You already have credit, you already have savings, you're already managing just fine. So why are banks bending over backwards to hand you a shiny piece of metal? That question sounds simple, but the answer reveals something really important about how the financial system actually sees you and what they're really after when they target people who, on the surface, seem like the last people who need another credit card. Most people assume credit cards are designed for people who are in financial trouble, that the whole business model is about catching someone when they're desperate, giving them access to money they don't have, and collecting interest until the end of time. And honestly, that's not entirely wrong. Part of the credit card industry absolutely runs on that. High interest rates, people carrying balances month to month, minimum payments that stretch debt out for years. That version is real, and it's worth understanding. But here's what most people don't realize. There's a whole other layer to this business, a completely different target, and it's not the person who's struggling. It's you, the person who's doing okay. There's this mental model a lot of us walk around with, that banks are generous to people in need and predatory to people who are risky. The reality is almost the opposite. Banks are extremely strategic about who they chase, and the people they pursue most aggressively with the best offers and the most perks are people who already have money, good credit, and stable income. Why? Because those people are the most profitable, just in a completely different way than you'd expect. This isn't a conspiracy. It's not even hidden, really. It's just that the business model behind premium credit cards is rarely explained in plain language. And when you don't understand it, you make assumptions. You think you got lucky. You think the bank is doing you a favor. Sometimes that's true, but more often, you're being specifically, deliberately, mathematically targeted. And knowing that doesn't mean you should panic or cancel everything. It actually gives you more power in how you use these products. So let's actually walk through how this works from the bank's side of the table. When people think about how banks make money on credit cards, they usually think about one thing: interest. You borrow money, you pay it back slowly. They collect 18 to 25% a year. Simple. But interest is actually just one of three major ways credit cards generate revenue. And interestingly, it's the one that high-income, financially stable customers contribute to the least. The second stream is called interchange fees. This one is invisible to most consumers, but it's enormous. Every time you swipe your card, every single transaction, the merchant on the other end pays a fee to process that payment. That fee typically ranges somewhere between 1% and 3% of the transaction, and it gets split among the card network, the bank that issued the card, and the bank that processed the transaction. Now think about what happens when someone with a premium card uses it for everything: groceries, business expenses, travel, car rentals, dinner with clients. The amounts add up fast. A high earner who puts $5,000, $10,000 or more through the card every month is generating hundreds of dollars in interchange fees every year, and they're doing it even if they pay off their balance in full every single month. The bank is collecting without that person ever paying a cent of interest. This is the key insight. The person who pays off their card every month and collects all their points? Banks have a name for them internally. They're called transactors. And despite what you might think, banks actually want transactors. They love transactors who spend a lot, because high-volume spending means high interchange revenue, with none of the credit risk that comes from someone carrying a balance. The third stream of revenue is the annual fee. Premium cards charge anywhere from $95 to $550 or even more per year. A fraction of that goes towards funding the rewards and perks, but if the bank's model is structured well, the interchange fees, the annual fee, and the interest from members who do carry occasional balances all stack up to a very profitable product, even for customers who are responsible. So when a bank looks at you and sees someone who earns well, spends regularly, and pays on time, they're not seeing charity. They're seeing a revenue engine. Now, here's where it gets interesting from a behavioral standpoint. Banks don't just want customers who have money, they want customers who behave in a specific way. And high-income, financially stable people tend to exhibit patterns that are almost perfectly aligned with what makes a credit card business profitable. First, they spend more. This sounds obvious, but it's worth sitting with. Someone earning 3 times the median income doesn't just buy the same things in larger quantities. They spend in categories that carry higher interchange rates. Travel bookings, dining out, premium retail, business services. These are not just high-volume categories, they're high-margin categories for the interchange calculation. Second, they spend consistently. Financial stability means fewer income shocks. Fewer months where spending drops dramatically because a bill hit unexpectedly or a paycheck was delayed. For a bank trying to project revenue, a consistent spender is far more valuable than an erratic one, even if the erratic one spends more on average. Third, and this is the one that doesn't get discussed enough, financially stable people are more likely to keep a card for a long time. They're less likely to cancel in year 2. They're less likely to default. And the longer someone keeps a card, the lower the cost of acquisition becomes on a per-year basis. Banks spend real money acquiring customers, mailing offers, processing applications, running underwriting. If a customer churns in 18 months, that acquisition cost was barely recovered. But if that customer keeps the card for 8 years, the economics are very different.
Here's something that reframes the whole system in an interesting way. Most people think of their credit score as a number that unlocks access to credit. The higher your score, the more you can borrow. That's not wrong, but it's incomplete. Banks also use your credit score as a targeting filter, not just to decide if you qualify, but to decide if you're worth the cost of pursuing. Credit card companies buy data. They use algorithms. They cross-reference income estimates, spending behavior, existing credit relationships, and more to build a profile of who is likely to be the kind of customer they want. And a high credit score isn't just about risk management. It's a signal that you've been reliably generating value for some financial institution already. You've been paying on time. You've been using credit without drama. You're a proven low-maintenance revenue source. There's a term used in financial services called credit invisible. People who don't have enough credit history for a score to be calculated. Banks avoid them not because they're necessarily bad customers, but because there's not enough data to model them accurately. On the flip side, someone with a 760, 780, 800-plus credit score is one of the most data-rich, most predictable customers a bank can acquire. Everything about their financial behavior has been recorded and analyzed. The bank knows, with pretty high confidence, what you'll do with this card. That's a product a bank is willing to spend money to get in front of you. Hence the metal card, hence the sign-up bonus, hence the lounge access. At this point, you might be thinking, okay, so banks want profitable customers. That's not news. Every business wants profitable customers. What makes this worth understanding is the intensity of the competition for a specific tier of customer. There's a segment of the population, roughly the top 15 to 20% of earners, where multiple banks are simultaneously running coordinated marketing campaigns to win their primary credit relationship. Not just a relationship, the primary one. The card that goes on every subscription, every expense report, every trip. Because here's what happens when someone makes a premium card their primary card. The interchange fees compound at scale. If you're putting $4,000 a month through a card, that's $48,000 a year in transactions. At even a 1.5% effective interchange rate, that's $720 a year in transaction fees before a single dollar of interest. Add a $550 annual fee minus the cost of the rewards they actually redeem, and you start to see a business that works even when the customer is financially disciplined. Now, multiply that across hundreds of thousands of cardholders in that income band. This is why Chase Sapphire, American Express Platinum, Capital One Venture X, these products exist. They're not generosity, they're deliberate engineering. One more layer to this, and it's one that doesn't get talked about fairly on either side of the debate. Points, miles, cash back, the reward system. Critics of credit card rewards will tell you it's all a trick, that the points have no real value, that you spend more because you're chasing rewards, that the whole system is designed to extract more from you. There's some truth in that, particularly when rewards-chasing behavior leads to overspending or to carrying a balance trying to hit a sign-up bonus threshold. But the full picture is more nuanced. For someone who already spends what they'd spend regardless, someone who would buy those groceries, take that trip, pay those recurring subscriptions whether or not a card existed, the rewards genuinely represent value transferred from the interchange system to the consumer. The merchant pays the fee. The bank captures most of it, but a portion flows back to you as miles or cash back. The problem isn't the rewards themselves. The problem is what rewards do to spending behavior over time. There's actually real research in behavioral psychology showing that when people pay with a card instead of cash, they spend more. The psychological friction of handing over physical money is gone. And when there's a reward attached to spending, even a small one, that friction decreases even further. So the reward isn't a trick exactly, but the whole system around rewards is designed to increase transaction volume. More spending means more interchange. The bank wins. If you happen to win too, that's not an accident, but it's not purely altruism either. This is the machine, and the person operating it most skillfully is the one who uses the card heavily, pays it off every month, redeems their points strategically, and understands that they're a valued but very intentionally selected customer. So let's sit with what this actually changes. When you understand that you've been targeted rather than gifted, something shifts. It's not alarming, it's actually kind of clarifying. You stop feeling vaguely grateful for the card you were approved for. You stop wondering if you really deserve the perks. You start to see yourself for what you actually are in this equation, a high-value customer that multiple institutions have done the math on. They want your business because your business is profitable. That's it. That's the whole thing. And once you see it that way, the dynamic flips. You're not asking the bank to give you access. They're competing for access to you. This matters practically because people who understand their position in this system tend to use it very differently from people who don't. The person who doesn't understand their value accepts the first offer. They sign up for the card the mailer happened to be promoting. They use it out of loyalty or inertia. They maybe never switch because switching feels like a risk. The person who does understand their value treats credit card relationships like any other negotiation. They compare products, they read the terms on the annual fee, they calculate whether the rewards they realistically redeem justify the cost. They don't carry a balance on a high-interest card out of inertia. They pay attention. There's also a deeper psychological reframe here that I think is worth naming. A lot of people with stable finances feel an underlying anxiety about money that their income alone doesn't fix. And part of that anxiety comes from a sense that the financial system is confusing, that it's designed for someone else, that they're kind of muddling through. Getting a premium card offer and not fully understanding why, that's actually a symptom of that feeling. Something happened and you're not sure why, so you just go with it. But financial confidence isn't really about how much you earn. It's about understanding the system you're participating in. And when you understand why you were targeted, why the offer is structured the way it is, what the bank is actually getting from your business, you stop being a passive participant. You start making choices from clarity rather than confusion. That shift is quiet, but it's significant. It changes how you evaluate every financial product, not just credit cards.
So what do you actually do with all of this? The first thing is just to do the math on any card you have or are considering, not the rewards math, the real math. What is the annual fee? What rewards do you actually redeem, not theoretically, but in reality? If you travel twice a year and the card promises airline lounge access and free checked bags and travel credits, figure out how often you've actually used those things, not how often you could use them, how often you do. The gap between theoretical value and actual value is where most premium cards lose their attractiveness. Someone signs up for a card with $550 in annual fee because the benefits are worth $1,000 in theory. In practice, they use the $200 travel credit, get some points they haven't redeemed yet, and skip the lounge access because they didn't know where the entrance was. That's a $350 annual fee for things you may or may not actually use. The second thing is to understand what kind of cardholder you naturally are. Are you a transactor, someone who pays in full every month reliably, or do you occasionally carry a balance? Be honest with yourself here, because the math changes completely depending on the answer. If you carry a balance, even occasionally, the interest rate on a premium rewards card is going to significantly erode the value of any rewards you earn. In some cases, a no-fee card with a lower interest rate is actually the financially smarter choice, even if it feels less impressive. Third, and this one is underrated, consider the relationship you have with your overall credit picture, not just one card. Your credit utilization, the number of accounts you have open, the age of your oldest account, these things matter for your credit score. Opening a new premium card for the sign-up bonus can make sense, but opening several cards in a short window or frequently canceling and reopening products can work against you over time. Be strategic rather than reactive. Fourth, don't romanticize the perks. This is maybe the most human piece of advice I can offer. There's something psychologically seductive about a metal card, about feeling like you've made it enough to have a black card or a sapphire reserve or a platinum. And that feeling is real, but it's also engineered. The weight of the card, the name, the concierge phone number, these aren't just conveniences, they're brand signals designed to increase your attachment to the product and reduce your likelihood of canceling. That's not cynical, it's just true. You can appreciate those things and simultaneously not be captured by them. And fifth, possibly the most important one, remember that financial products are tools, they're not identities. A premium credit card is not evidence that you've arrived somewhere. It's a product with a fee structure and a reward mechanism, and you're either getting good value from it or you're not. That's the only question that matters. The best-positioned people in this system are the ones who use it without being used by it, who take the interchange value, redeem the points, pay zero interest, and never once feel like they owe the bank anything for the experience. Because they don't. They're the customer. They always were. I want to leave you with something that goes a little beyond credit cards. Understanding why banks target financially stable people with their best products isn't just useful for evaluating a credit card offer, it's a lens for understanding how most financial products work. Insurance companies want low-risk customers. Investment platforms want customers with money to invest. Banks want depositors with large, stable balances. Every sector of the financial industry is running a version of the same algorithm. Find the customers who generate steady, predictable value and compete to acquire them. That's not predatory, that's just business. And knowing it puts you in a different position. Because most people go through life feeling like financial institutions are doing them a favor, like they're borrowing the bank's money, using the bank's card, getting approved for the bank's product. There's a subtle power imbalance in that framing. It keeps you in the position of someone being served rather than someone being competed for. But here's the reality. If you've built a stable financial life, even a moderately stable one, you're not just a customer, you're a target, a desirable one. Multiple institutions would like your business. They've run the numbers. They've designed products specifically for people like you. That doesn't mean you should be arrogant about it. It means you should be informed about it. It means you can walk into any financial product decision, credit card, mortgage, investment account, insurance policy, with the quiet understanding that you have more leverage than the default experience of being a customer tends to suggest. The goal isn't to game the system, it's just not to be gamed by it. And honestly, the difference between those two things often comes down to knowing how the system works in the first place, which is most of what financial education really is, not formulas and spreadsheets, but understanding the incentives of the people sitting across the table from you. You've got this. Progress beats perfection. And knowing this stuff, even a little of it, puts you ahead of where most people are. Take care of yourself.